Advantage Corp. John, thanks for being on with us today. What kinds of questions should investors really be asking themselves as they say they want to rebalance the portfolio? But what are the questions you should ask yourself before you actually try and do that?
Well, let's just begin, Nicole, with understanding that balancing a portfolio may not be much different than beauty. It's all in the eye of the beholder. So when people say they're rebalancing to what? Rebalancing for what purpose? Is it in arrears, like after the last quarter, or is it forward thinking? Have you looked at your goals? Is it the case that you're trying to accumulate $2.6 million to retire with the same $100,000 income or so in the next 30 years? Or is it the case that you have $5 million and the last thing you want to do when you're taking $200,000 from a $5 million account is watch what was a 4% withdrawal become an 8% withdrawal because the 5 million dropped to 2.5. Now we've got to double the withdrawal level just to keep the same $200,000 showing up every year as you have become accustomed. So it's really a number of questions I think investors should be asking above how to rebalance. But again, what are we trying to do here as opposed to feel like we did something just because we reorganized the portfolio into our traditional 60% stocks or 40% bond model?
Right. So when you have an example now from Yale University and you have some findings, so you're going to show us that, John, show us that and explain what it is that you're thinking here.
Yeah, I appreciate the question because, it's not a template. We're not saying that anybody should do this. But certainly success leaves clues, and I think it makes sense to follow the smart money. So the first thing that blows my mind when we look at the Yale portfolio, I believe it's about $30.3 billion as of June 30, 2019. They do it once a year. Their exposure to stocks, no one would imagine the exposure to stocks would be all of 2.75 in the U.S., 2.75. Internationals are 13.75, and cash or bonds are about 7%. So if you just add up those top three, which, by the way, was how they used to hold 75% of the portfolio in 1989, and the way many of us continue to hold portfolios today, we see that their exposure to cash, bonds, and stocks, including internationals, is all of something like 23.5%. That's just very low. So notice there are no big bets. And let's also notice we can count 7 or 8 different asset classes. Clearly, 8 legs under your portfolio stool is going to be stronger than 2 or 3 legs underneath the same stool. So to as I say, looking at some of the best and the brightest, there may be some clues here that we can undertake in our own portfolio.
So the biggest change there, I was trying to read through the bullet points, was some of the other assets like real estate, because it said that cash seemed to be consistent from the 1980s through now. What were the big changes? I mean, just spit it out so people can get it.
Yeah, well, in terms of real estate, when we look at so many people, when we sit down with them and they think they're diversified, they tend not to be. And in many cases, they're completely lopsided. Like they have $3 million in 3 houses that are paid off at $1 million in the market. That's lopsided. That's not balanced any way you look at it. And then when we look at Yale, we look at 23% to absolute returns, 21% to venture capital, 16.5% to leverage buyouts. Real estate is 10%. That's certainly lower than what most of us do on the retail side. Our numbers tend to be much higher when it comes to real estate. And then, natural resources, 5.5%. Again, I'm not saying that these are the things to do. What I am saying is notice how they made their portfolio more complicated to provide for more consistency. At the end of the day, Nicole, we all know we want more consistency.
So what's interesting, a lot of people say, right, a home is not an asset, it's a liability. And you just said that. You basically said if you have 3 homes and they're all paid off, right, each one's $1 million home, and you have $1 million in the market, that's not the way you should do it. That's lopsided. Why is that? Do you not suggest people pay off the homes, or is it just too much in real estate?
I think let's put it this way. Out of a $4 million portfolio, I would never recommend, and I 2 things. I would never recommend one stock to put 80% of your nest egg, nor would I recommend to put 80% of your money in an illiquid position. Now, if the SEC says, oh my goodness, John Grace just recommended $3 million out of a $4 million account to a real estate investment trust, we would all agree that's hue and cry, get him out of the business. But when people find their ways into these positions on their own, everything's fine. And at the end of the day, the investor does not recognize how their portfolio is put together. They just believe, well, I have real estate, I have stocks, I have bonds, I have cash. I'm diversified. We don't look a little closer under the hood to see what are those percentages that you think you have diversified. Because, again, 80% in any one place is going to be a huge bet. And I love Warren Buffett's quote, risk is not knowing what you're doing.
Right. Yeah, that's actually right on point. And so many of us don't, right? You're so busy working or dealing with family and you don't follow the investments as closely as any of us should sometimes. John Grace, wonderful to see you. Thank you for your insight. Founder, president, Investors Advantage Corp. Thanks, John.